The broader markets, S&P on pace for its sixth positive month in a row. Wharton School of Business professor Jeremy Siegel joins us now. Professor, it's nice to see you.
Good to see you, Scott. Don't usually see you in the morning.
Yes, sir. It's nice to see you as well. November, December. Okay, October's in the books after today. What's this market going to do for the remainder of the year?
Well, I think part of it depends on the election. And I think, when we see the VIX up at 22, there seems to be a lot of anxiety, a lot of uncertainty on what that outcome is. Now, I think when it's resolved anyway, that usually brings the market back up. But, when you see a yield of 433, and in my calculation, I see now, believe it or not, only 3 25 basis point cuts between now and next June's meeting. There are 6 meetings left, 2 this year, and then 4 through June. That really means the market is really just expecting almost every other meeting a 25 basis point cut. Now, compare that with right after that 50 basis point cut where they were expecting at least one cut every meeting. So that revision upward, puts a new look on the market. It looks a new look on bonds. I mean, stocks are strong because it means the economy is just much stronger than people think. So, earnings will trump interest rates for stocks, but certainly for bonds, they're not good.
Well, I mean, what's more attractive here, stocks or bonds? I mean, the Fed is going to cut, whether it's, 3 versus 6. The trajectory for yields presumably still is lower. Now, obviously, they backed up a bunch, which some would suggest make treasuries attractive here.
Well, I don't know how attractive they are. One has to remember through history, the 10-year is on average between 100 and 150 basis points above the Fed funds. Now, if they are going down, and I really don't think they're going to be going at most down to 3.5, even though their projection is 2.9, I think it's 3.5 to 3.75 now is that neutral rate. And if you add 100 to 150 basis points to that, you're near the 5 level on the 10-year. People are all surprised, and we've talked about this before, that the long rate has gone up while the Fed is on a downward path. But what we are is reverting to the normal structure of interest rates, which is long above short, and we have not completed that transition yet.
Mm-hmm. But aren't fewer cuts better? I mean, you were arguing, maybe you said the 50 basis point cut was too much. Maybe they don't need to do more.
Well, I think we need to do more. As I said, I see it going down to 350, down to 375. So, we're talking about 100, 125 basis points below there. But then if you add the normal term premium, if we finally got out of this crazy inversion that we've had in the term structure for the last 2.5 years and get back to normal, which is what the Fed wants to do, you've got to add that 100, 150 basis points to the 10-year. And at this point, we're not there yet, even with the Fed on a downward path.
What do you think about the mega cap trade or the tech trade, which, after sleeping, I guess, for the third quarter, has woken up more? Now, the NASDAQ obviously has been hitting record highs. We're getting and figuring out what we want to make of Meta and Microsoft. We got Amazon and Apple this evening. But where are you on that outlook?
Well, the interest rate, both the long and the short interest rate, is just not as important to the big tech as they are to the small and mid cap. And the reason why, this, much called for small cap, mid cap revival has been short circuited is because now, instead of thinking, oh, yeah, the Fed is going to be really in the low threes, by the middle of next year, oh, maybe they're going to be in the high threes, and we don't know how fast they're going down. So I really think that the reason why large cap has held its own and small cap hasn't gone up is really this revaluation of what's happening on the interest rate structure. Listen, the narrative on AI is still there. It's one of the strongest narratives we probably have had in the market since .com. That went on for many years. Now, I'm not predicting a bust here because these stocks are nowhere near as crazy as we were in 2000. But narratives go on for quite a while, and they don't disappear unless they get punched many times with disappointments. And, listen, we've had a few maybe slight disappointments on guidance on these, but not enough, I think, certainly in the short run to change the trend and the story.
Good seeing you as always, Professor. Be well. I'll see you again soon. I'm sure of that. Jeremy Siegel.
Thank you,
Wharton
Scott.
School.